Good evening and welcome to the conference call of Hindustan Unilever Ltd. We will be covering this evening's results for the quarter ended 30th June 2018. On the call from the HUL end is Sanjeev Mehta, Chairman and Managing Director, and Srinivas Phatak, CFO HUL. As is customary, we will start the presentation with Srinivas sharing aspects of our performance for the quarter and then hand over to Sanjeev for him to share his perspective on the business performance. Before we get started with the presentation, I would like to draw your attention to the safe harbor statement included in the presentation for good order's sake. With that, over to you, Srinivas.
Thank you, Suman. So we have basically covered three elements, a quick update on our strategy, spend some time talking about our quarter performance, and a view on looking ahead. From a strategy point of view, I think it's a clear and a compelling strategy which has worked well for us over many quarters and years, and that remains unchanged. A very clear strategic framework, a compass at the heart, and really a growth model which is consistent, competitive, profitable, and responsible. When I see it from a June quarter point of view, we've clearly seen a gradual improvement to demand, and that has really continued. In that context, HUL has delivered a strong volume-led growth. If I now go a bit into the headlines, our comparable growths, domestic consumer comparable growth are at 16%, with underlying volume growth at 12%. Our EBITDA margins comparable are again up by 100 basis points, and EBITDA at 2251 crores is up 21%. When you were to see from a quarter point of view, our COGS has been lower, and that's been primarily account of benefits coming from a positive mix, some judicious pricing actions, and the savings agenda, which is continuing to work well. From an A&P point of view, we have stepped up our investments in the quarter, again driven by innovations, activations, and competitive actions. Our PAT BEI is up 21% and our net profit up 19%, given some exceptional items. You've seen this chart before, and I think it's important to do a recap of the accounting impact of GST. This is the last quarter where we're going to see this impact as it anniversarizes. But important to highlight that this has an impact both on the reported growth and the reported margins. From a reported growth point of view, if you really see, our reported growths are at 3%, but our comparable growths come to 16%. And this is really catering to the accounting impact of excise duty, the fiscal exemption refunds, and some input taxes. For the investors who are also invested into Unilever, it's important to highlight that our growth from a Unilever point of view will stand about 11%, basically taking into the accounting treatment, which is different between the two entities. When you see it from a profit, you see a mirror image. While our reported growths go up, our comparable margins are only at 100 basis points, unlike the reported 350. And this is something which we have always called out for the last 4 quarters, and you see the effect coming through here. Important to highlight that from an absolute EBITDA point of view or an EPS perspective, these do not impact because these are only BIPS changes coming through from an accounting perspective. So in essence, if you really look at our performance, it's 16% comparable growth with 100 basis points of EBITDA expansion with 12% UVG. Another important piece to call out is, I think we had announced earlier, we have looked at our organization structure and we have actually integrated our foods and refreshments divisions. And therefore, when you really look at our organization, it has been done with the objectives of making it more simpler, agile, and a more focused business. From a home care point of view, there is no change. Personal care is now designated as beauty and personal care, which is reflective of our strategy and our portfolio. And foods and refreshments will now include also our food solutions business. So accordingly, our management structure is now designed to really run the businesses on the likes that we have stated on this chart. So therefore, when we really look at it, I think the clear call-out is that we have had a double-digit volume growth across all our 3 divisions. Home care has grown at 20% comparable, and beauty and personal care at 14%, and foods and refreshments at 14%. Innovations and activations continue to be clear and important for us, and during the quarter, which has been a continued focus, be it in some of our core brands such as, if you really look at Surf and if you look at Ponds, or if you look at some of our key and new innovations. For example, we have really launched the Brill Cream range for men grooming in partnership with Amazon on the e-commerce side. So this starts to give you a flavor of the work that we continue to do on the core, as well as some of the emerging segments. As we've always called out, both core and market development continue to be key to really continuing the growth. If I now look at some of the categories, I think from a home care point of view, it's been a robust growth. Fabric wash has grown in double digits across key brands and the momentum continues. The double-digit growth performance in household care was led by Vim. And we have also said during the quarter, Domex liquids was relaunched in South and powders extended to the other geographies. From a purifier's point of view, I think our overall performance was subdued, while the premium range has performed well. When I move to beauty and personal care, it's a broad-based growth across personal products as well as personal wash. In personal wash, the high growth trajectory in Dove and Pears has been sustained during the quarter. Skincare again registered double-digit growth on the back of good performance by Ponds and Fair & Lovely, and the facial cleansing continues to maintain a strong momentum. The hair care growth was really led by performance of the premium portfolio, and Indulekha again had a very strong performance during the quarter. When I look at the other parts of the portfolio, in color cosmetics, this has been a business which has seen consistent momentum and double-digit growth over many quarters. We had one more good quarter during this year, and that continues to come from the continued rollout of innovations and the performance on the core. We've also called out where you can see the Lakme 9 to 5 range was really introduced with some clear call-outs and benefits. Oral care is a business which has been challenging for many quarters. We have seen another quarter of growth, but there is more work to be done, and we continue to tweak our mixes and the portfolio on this side. Deodorants, we have seen impressive growth, and Axe Ticket, which is an innovation we put out into the market in the previous quarter, is gaining a lot of traction. When I see from a foods and refreshments, there's been strong growth in tea and ice creams. In tea, we have seen double-digit growth across all our key brands, and Bru Kannadigar was launched in select geographies. Ice creams and frozen desserts, you see, the June quarter was really where it was our season, and during the season, we have delivered strong double-digit growth on the back of innovations and geography expansion. And the foods growth was really led by Kisan and Nor. And as we shared during our annual investor meet, the Lever Ayush breakfast range has been launched in Tamil Nadu. Now, this chart gives you a total picture of our reported numbers and a clear call-out, as I said, 3% reported growth with 16% comparable. I think here we'd like to really draw your attention to one other additional element, or actually two additional elements, when you really look at it from another income, which is really higher compared because of the higher investable funds in the business. On the exceptional items, we have taken some provision towards restructuring and few contested matters. You would recollect that we had called out that in a post-GST environment, we will continue the path of really finding an efficient and an agile and a responsive supply chain. And accordingly, we've started to restructure some of the supply chain components. So we have taken a charge during the quarter. And I think it will also be pertinent to call out that as we continue this path of getting more efficient and agile operations, we will see some exceptional items which will continue to flow over the next few quarters as we work the plans through. So when I really now look at looking ahead and the last chart, I think the trend of gradual improvement in demand is still intact. Crude volatility and currency-led inflation will be key watch-outs for us. And as we called out earlier, step up in competitive intensity is anticipated. Our strategy of focusing on volume-driven growth and improvement operation margins is intact. And we continue to drive growth which is consistent, competitive, profitable, and responsible. And here I would now like to hand it over to Sanjeev for his perspectives on the in-quarter performance.
Thank you, Srinivas. Good evening, everyone, and again a pleasure having you on the call. As we mark the one-year anniversary of GST, it is very evident that trade conditions have normalized. We are also seeing the consumer demand or the offtake moving up as compared to the real lows that we saw in 15 and 16. Markets across urban and rural are seeing a positive trend. This augurs well for our industry, and in the medium term, we are hopeful that the underlying demand drivers will sustain. However, as I mentioned in the previous couple of calls, I think we should wait for a few more quarters to see whether a clear trend is emerging. Very pleased with our current quarter performance. Three key numbers to note: 16% comparable sales growth, 12% underlying volume growth, and EBITDA margin expansion of 100 bps. The highlight was that all the three divisions performed well and registered double-digit volume growth. Now, when we look at Home Care division, its performance has been again stellar with double-digit growth in both laundry and household care. Laundry strong premiumization story continues with the premium markets growing 3x of mass in terms of volume. We also maintained our focus on the mass segment with the quarter seeing the launch of a new wheel communication, which aims to strengthen the brand equity through relevant purpose-driven activation. The household care delivered another strong performance with market development activities on Vim. We relaunched the Domex liquids in the south, and the Domex powder, which we had innovated for squat toilets, we have now extended it beyond the initial test market of others. The overall performance of the purifiers category was subdued, and we are clearly seeing a trend where the gravity purifier segment is declining. Moving to the beauty and personal care division, we had broad growth across personal wash and personal products. In personal wash, the premium part of the portfolio continued to deliver strong performance, led by Dove and Pears. Skin care had a great quarter, sustained its double-digit growth on the back of FAL and Pond's. Pond's Talc Starlight variant launched in March quarter is performing very well, and the facial cleansing segment is also seeing an accelerated growth. The hair care category saw robust growth across the key brands in the portfolio. We also launched the Brill Cream beard and hair grooming range exclusively on Amazon to tap into the growing male grooming market. This test and deploy approach is in line with the aim to build nascent categories with some of our key strategic partners, wherein the target consumer group is more skewed towards the propensity to purchase online. It gives us a good platform to really understand the potential for some of these products and develop mixes for the long term. Deo also clocked robust growth with both Axe, Ticket and Rexona antiperspirant continuing to perform very well. As Srini mentioned, we have integrated foods and refreshment division, which together delivered double-digit growth in the quarter. Tea continued leveraging on the WIMI strategy and delivered broad-based growth across all the brands, key brands. We refreshed our communication on Red Label Natural Care and Green Tea in the quarter, and also launched the second edition of the six-pack band, which strengthens the Red Label message of promoting inclusiveness within our community. Ice cream and frozen desserts had a great season on the back of innovation and geography expansion. In foods, Kisan and Noir grew in double digits, and we also launched our Ayush breakfast range in Tamil Nadu with the vision of making traditional ingredients contemporary. So if we look at all the three divisions performed well, and it was a very satisfying quarter. Our focus on strengthening our core, driving premiumization, building the categories of the future through what we call in market development, combined with a relentless drive to unlock operational efficiency through our Symphony and ZBB programs continues to hold us in good stead. Another important area where we have dialed up focus over the last couple of years is investing behind capabilities across the value chain. be it in customer development, marketing, or supply chain. When you visited us during the investor meet, we showed you the work that is being done in this area, and I must reiterate that my strong belief that the initiatives we are driving under reimagining HUL, using technology, data, analytics, IoTs, and AI, will propel us into the future and redefine the landscape in which we operate. It's going to be a very exciting journey. With that, I would like to hand the call back to Sumit.
Thanks, Sanjeev. Thanks, Srinivas. With this, we will now move on to the Q&A session. Ideally, we'd like to close the call at 7:30 p.m. So I would just request all the participants who want to ask a question to keep it really tight so that we can accommodate as many over the next 60 to 65 minutes. In addition to the audio, as always, our participants have an option to post the questions through the web option on your screen. We encourage you to do that, and we will take those questions up just before we end. Before we get started with the session, I would like to remind you that the call and Q&A session are only for institutional investors and analysts, and therefore if there's anyone else who's not an investor or analyst but would like to ask us a question or engage with us, please feel free to reach out to the investor relations team out here. With that, I would like to hand the call back to you, Aman, to manage the next session for us. Aman, over to you.
Thank you very much. We will now begin the question and answer interactive session for all the participants who are connected to the audio conference service from Chorus. To ask a question, participants may please press star and 1 now. The first question is from the line of Avnish Roy from Edelweiss. Please go ahead.
Sir, congrats on a very good set of numbers. My first question is on the Qtr1 brand. Sir, two subparts here. One, in purifier, you have been telling for the past few quarters that premium has done well. This quarter, you have also said that overall performance was subdued, and you said gravity is declining. So wanted to understand what is the way forward here, because you have also been advertising heavily on the lower end, wherein you say that this is a very low pricing. So why that's not working? And second, air purifiers has been launched 6 months back. So any update on that?
Yeah, thank you, Avnish. First is, we are consistent on purifiers. What we are saying is that the RO UV, both the premium and the low price segment, both are doing well. What is not doing well is the gravity purifiers. Now, we have to understand why gravity purifiers are not doing well. Now, as the water table goes down, you find that the taste of the water and the water becomes much harder. And so the purifier requires to not only remove bacteria, but also the hard elements in the water. And that is the reason why people who have the habit of getting into purified water are switching over to RO and UV. Yeah, so that is the reason. And our thrust on RO and UV continues unabated.
And so how is air purifier?
Air purifier is early days. Yeah, it is still a very small business, and we have to build the market. Despite huge amount of air pollution, अभी भी भारतवासियों में आदत नहीं पड़ी है purifier लेने की. So we will convert them slowly and steadily to using air purifiers.
So my second question is on the toothpaste. There is some change in commentary from your side. You said in this quarter in the presentation that another quarter of growth. In the earlier quarters, you have been saying close-up has run reasonably okay. So has Pepsodent also, has it picked up? And I see marked increase in your promotion. So is that also working?
See, first is, I don't think we are declaring victory in oral care. What we are saying is we've had 2 quarters of growth, which is a good sign. And within our portfolio, very clearly, Close-Up is doing much better than Pepsodent.
But it is not broad-based, right? Because...
नहीं, Pepsodent में अभी और काम करना है, Avnish.
Is there any update on the Ayush in toothpaste specifically? Because that's a large competition has a large market share in that. Yeah. How has that picked up in South India?
See, what I would say is Liver Ayush in South India has been tracking as per the plan. But more importantly, Avnish, our natural strategy, which is now an integral part of our strategy, which has three legs, as you know, is master brand, specialist brands, and variants within our existing brands. That continues to perform as per plan. We had set for ourselves a target this year that we'll grow at 2.5x the average growth rate of the company, and it is tracking well as far as the first 2 quarters of this calendar year are concerned.
Okay, sir. That's all from my side. Thank you.
Thank you, Avnish.
Thank you. The next question is on the line of Amit Sinha from Macquarie Capital Securities. Please go ahead.
Thanks, sir, and congratulations on a great set of numbers. My first question is on your segmental numbers, and clearly home care has outperformed the personal care in the last few quarters, both in terms of revenue growth and the margin expansion. So in the GST regime, this outperformance has actually further increased. So just wanted to understand, is it a function of significantly different competitive environment in these two categories, and going forward, will it normalize?
Okay. First, let me step back and talk about the numbers for the quarter. If you look at the UVG, we are talking about 14 in home care, 11 in BPC, that is beauty and personal care, and 11 in foods and refreshment. So all our three divisions, as far as UVG is concerned, has performed well. Yeah. So we don't need to worry about that. The rest of my division, whether they are performing well or not, they've done well. And it will never happen that all the categories will grow at the same rate. Some categories at some stage will grow at a faster rate, and then the changes happen. So long as a portfolio, we keep doing well. And we are very pleased with the performance of home care, which has been on a great growth trajectory. And both household care and laundry doing very well. A bit of concern with water purifier, which we just alluded to. And as far as BPC and FNR is also concerned, you also have to look at the context in which we are operating. We are pretty satisfied with the performance of these two divisions.
Yeah, clearly, in the revenue growth terms, clearly both the segments have done pretty well. But when I look at your segment EBIT, the growth is significantly different. That is where I was coming from.
Okay. If you're talking of margins, then you also have to accept that home care is coming from a very low base. Yeah, and it was a very conscious strategy that we had put together in the last few years, that we have to make home care much more profitable. And that has worked wonders for us. We have not only improved the margins, but we have outpaced the market very clearly.
Yeah, so maybe again just to clarify, Amit, while you'll also see a slight step up in margin on a sequential basis, I think it's important to call out saying that, look, as we start to see inflation coming through, there is always a certain lead and lag. In some cases, you have to manage pricing judiciously, and in small step-up changes, we do that. Some of the cost inflation which comes through, we also had the benefit of some of our stock covers and forex covers, and there's also some savings. And there's also certain phasing of other costs. So therefore, I don't think one should only look at the quarter. As you continue to see it over a period of time, as is the case, you'll see that some of the margins progression will start to normalize a bit. Overall, I think the comment from Sanjeev is right. There's a step up in margins, but I don't want you to read too much into the quarter numbers from a home care margin point of view.
Yeah, clearly, I think just a follow-up on that. So if I look at the quarterly margins of these two segments, there was a difference of almost close to 10% in first quarter of FY18. This quarter, the difference has come down to broadly around 600 basis points. Going forward, the home care margin expansion should not be to that extent, right? If I'm not very wrong.
So look, without getting into the percentages, clearly I think there are two different nature of businesses with a very different gross margin profile, PMI investments. And clearly, I don't, without getting into 610% levels, but I think if you see our historical trends and even if you see last year numbers, they'll be more reflective of some of the way we will run the business. Whether it's going to be moving up 100, 200 basis points here or there, that's a function of how we invest, what we do, how we grow, multiple factors.
And the imperatives are very different when you look at from this two division perspective.
Sure. So secondly, on the cost savings program, last year you had given a kind of target of 6% of cost savings, which you are targeting for the full year as a percentage of turnover. Just wanted to understand if you have any number for this year and what was the broad delivery on the cost savings last year?
So look, Sanjeev is very clear and he's been a hard taskmaster. I think his direction continues to be, if we've done that in the previous years, we need to find ways of repeating it. And therefore, there's a very clear program and we continue to work through on it. Yeah, so in a similar levels is what we will continue to go after. But again, as we've always said, generation of savings and deployment savings are two different things. And therefore, we will continue to target at least internally the savings in the similar range, and then we'll deploy as per the needs of the business.
Okay, sir. That's it from my side. Thank you.
Thank you. The next question is from the line of Abhishek Roy from Stewart & Mackertish. Please go ahead.
Yeah. Good evening, sir, and congratulations on good set of numbers. Sir, I have a question regarding the understanding of the volume growth. So, sir, can you just let me know how you identify that volume growth? That is that based on that unit that is sold or based on the volume that you manufacture and that is sold?
Volume growth is based on what we sell from Hindustan Unilever. And we talk about a nomenclature called underlying volume growth, which is essentially removing the pricing effect of volume sold at constant price.
Okay, sir. So that doesn't have anything factor with the unit that is sold, right?
If a unit based, you're talking of, are these pieces that come into account? Then the answer is no. Yeah, it gets into calculation as tons.
Okay, sir. Thank you, sir.
Consistent definition over the years.
Yeah.
There are pieces, there is tons, and there is UVG. So I think there are slightly different nuances, and it's consistent over many years now.
Okay. Okay, sir. Thank you, sir. And my next question is regarding this rise in crude oil prices, because that when I checked that the crude oil prices has increased by 40% over 1 year. So do you think that will have any impact? Means how much that will be? How much impact that will have on the profit margins going forward? Suppose for the next 2 quarters.
So will it have an impact? Yes, it will absolutely have an impact because it's a sizable increase. We've started to see that in this quarter, and we expect to see some more of it coming through because we've also had some benefit of covers that we have taken in the past for some of our key materials. So we don't want to get into specifics of how much will be the impact on the P&L. Suffice it to say that all levers will be looked at to manage it. And that's also, if you see, even in the quarter, we've also talked about judicious pricing. Even if you see in market, you've seen that we've already started to take up some pricing in select packs, categories, and geographies to manage the totality of the equation. Having said that, it's also important to call out that when it comes to some of the other elements of cost, such as veg oils, palm and palm lead, it's been benign so far. But as you continue to look into the future, yes, we are seeing a lot more volatility in crude. Currency is looking under pressure. And if these two then start to play out, therefore the inflation pressures could be elevated. But that's something that we need to watch and manage carefully.
Okay. Thank you, sir. Thank you for your answers and all the best.
Thank you.
Thank you. The next question is from the line of Bhavesh from CLSA. Please go ahead.
Hi, good evening, everyone. This is Vivek. A few questions, please. First, your comment about repetition from fourth quarter about the risk of competition picking up in a inflationary environment. Why are you highlighting this as one of the big concerns?
Yeah, hi Vivek. When we talk about competition, we are not talking about just from a lens of laundry products. Because if you look at today, there are some categories where the raw materials have remained very benign. Say vegetable oils, for instance. We are not seeing inflation over there. Whereas absolutely right, there has been a price increase as far as laundry is concerned. But we are anticipating, and if you look at the last couple of quarters, the A&P spends have gone up. And we are anticipating that the competitive intensity and heat will remain.
Would you say that is very unusual, Sanjeev? Because if when crude was, let's say, half of where it was, perhaps we did not see as much of hyper competitive activity, something that we saw in 2007, 8, 9. Whereas now you are and again this comment about competition, I don't remember seeing it in the last 3 years. I think it is something that I'm seeing for the last 2 quarters. Maybe I may be wrong on that, but is there something that I'm missing in this?
So I think Vivek, we didn't call about hyper competitive activity. We have not used that language. I think 2 or 3 elements. There are certain. Okay, I think let's just step back. First, I think this is what we explained last time, and let me try and again put some color to it. We have seen trade normalize. We have started to see an uptick in consumer demand. You've also seen that the growth rates of us as well as the broader sector have started to grow, which by definition is obviously there is an attractiveness to capturing more growth. So that's one, I think, which is important. Second is that when you cut the categories, there are 2 or 3 things at play. There are some categories where we said there are inflationary pressures have not yet played out. Yeah, yes, while there is crude and there is a pass-through secondary effect which comes through, but if you really look at what's happened to palm oil and some of the veg oil complex, it's either benign or actually, in fact, some of the costs are there historical lows. How long, we will see, but that has also meant that there is some benefit. If you look at some of our categories such as tea and others, you still haven't seen the next round of crop, which only then starts to come in Q3, Q4. Again, the indication so far is that, look, people are sitting on historically bought stocks, therefore the inflation has not yet come through. Then there are some other categories where you see, for reasons which best each of them understand and according to their strategic plans, you see that some of the promotional intensity in modern trade has started to go up. Equally, as we have invested behind our brands, people have invested behind their opportunities. We're also looking at some of the A&P spends overall start to go up. So when you marry all of this, we will now come into an interesting play where there is growth to be taken and there is opportunities to be had and different dynamics playing out. Is it any 1 or 2 people really doing it broad-based? The answer is no. Yeah. So therefore, that's the reason we said, we called out, look, competitive intensity anticipated, and we still believe it will be there. Are we calling it as irrational at this stage? We have not called an irrationality, while there could be some pockets. But that, I think, in a manner captures the totality of the story. I don't think it's hyper, and I don't think we need to take a broad-brushed approach across all categories and all competition.
Okay. Thank you for this. Second, somebody had asked it, but I have a very specific one about personal care margins. This is the 4th quarter in a row where I'm seeing roughly around 120 to 150 basis points, margin cut. What is the reason why there is, is it just a mix thing because soaps is growing faster than, let's say, rest of the personal care? What exactly is driving this, let's say, 150 basis point margin cut in 1st quarter and around 100 basis point cut over the last 3 quarters? This is 4th quarter where margin cut is 100 basis point plus.
Okay, so if I talk about the quarter in question, I have also talked about exceptional item which is relating to supply chain reorganization. There are parts of our industrial footprint, there are parts of our logistical footprint, So during the quarter, we have taken a charge for that. And when you look at our segmental results, even the restructuring comes into the profitability. So that, let's say, is the key reason. Second is, again, honestly, I think 100 basis here or there, given the innovation intensity that we are running and some of the pipeline of what we have been doing. We had Ayush launches, we had Pure Derm. We continue to invest behind many of our brands. And in that context, the 100 basis points move here or there is par for the course, and we are very comfortable with that, Vivek.
Okay. And my last question is, again, on this exceptional item, could you highlight the nature of this item? Because when I look at annual report for 2018, provisions have jumped up from 870 crores to 1423 crores. Is that what is, partially, and you have mentioned the same thing, restructuring and few contested matters. Could you elaborate on the nature of these items?
So we are looking at reorganizing some of our 3Ps, to give you a flavor of, okay, let me also clarify this and also what you're likely to see in the next few quarters. And I don't think this has got any correlation with what was in the annual report. That's really talking about 31st March. We're clearly looking at restructuring some of our 3P, 2P operations. We're clearly looking, and I think we've called out that, look, we've got a DCs which are over 40. Eventual roadmap is to take them down to 20. Once we start to open up these two, we'll also then start to look at our own industrial footprint. It could either be some parts of our portfolio which may rejig between one factory to the other. And we're also relooking at a totality of our footprint, because now is an opportunity for us to really run a supply chain which is fit for purpose. So some of these costs will basically mean that if I'm restructuring 2Ps, 3Ps, there could be payouts which we do for people. There could be some write-down and write-off of some assets that we will end up doing. And this basically will translate into a rejig supply chain which will be more cost optimal and efficient and effective from an operations standpoint. So that's how some of the restructuring you've seen here. And this is where I also want to clarify that over the next 4 to 6 quarters, we'll see some quantum of this coming through, depending on what really gets announced, because all of these are determined by accounting principles. Depending on what happens, you'll also see some more restructuring in future.
Okay, sorry, my specific point was more about the contested matters that you're talking about, more than the restructuring. So what are these contested matters? Because again, as I said, annual report, there is this increase in provision to the tune of 600 crore, bulk of which is, it appears because of these contested matters related to taxation or excise or GST.
So in this quarter, we've actually had a reversal because we have got some favorable orders on some of the matters. And really appreciate that if you have a specific question on contested, please split the two, because otherwise I'll end up answering questions which are not relevant.
Okay, but can you elaborate what is contested matter, the nature of these?
1 second, Vivek, just be patient and listen to me. There were some contested matters on which we have had some favorable orders. That's a standard definition that we've used in line with what we have done previously. So in this case, we've got a favorable order and it's a reversal, it's a net number. So we've got a favorable order in the quarter.
Okay, I'll probably take it offline. Thank you very much.
Thank you. The next question is from the line of Avi Mehta from IIFL. Please go ahead.
Hi, sir. This is Percy Panthaki here. My question was on your response to some of the promotional activity that is going on in the market. And this question comes from a historic perspective. You've had price wars with P&G in 2004 and 2010. And each time that P&G has made a move, you have responded immediately and unflinchingly. And currently, I see a similar situation in the market where via promotions, Ariel is offering 33% lower price. But correct me if I'm wrong, I don't see any kind of similar response on Surf. So what is different this time? Why is your response different this time?
Yeah. My friend, you should see the growth that we have delivered at home care. Yeah. And we play our strategy, they play their strategy. We have been growing our market, growing our shares. We are in a fabulous position as home care is concerned. And if the need arises, we will respond. And we are absolutely clear that we want to remain our competitiveness in the market.
So, sir, just a slight follow-up on this. This promotion has been in the market for about 3-4 months now. And the fact that you have not responded, shall I take it to read that their promotion is not really garnering a lot of volume growth for them?
I can only tell you one bit, that despite the promotion, we are growing handsomely.
Very clear. Thanks, sir. That's all from me.
Thank you. The next question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks for the opportunity, sir. First question, over the last couple of years, do you think the affordability of your products is improved significantly because of RM cost inflation followed by GST rate cut? And is it fair to assume that as and when the price increases are required, you should be able to pass on without any meaningful impact on volumes?
I think you have made a very right point that with the GST and the commensurate price reduction that we did, that even if inflation comes in, it cushions as far as the consumer is concerned, because they got a benefit of 8-9% across several categories.
Okay. And second question again, slightly connected. You reported 2 consecutive quarters of 16% sales growth, which on a like basis. To what extent do you think GST rate cut has helped there? And as that anniversarizes, can we expect some slowdown? And that's the second question. And any further benefits of GST which you are looking at?
Yeah. When you look at the reported numbers, you also have to look at the base numbers. Yeah. And if the base quarters commence starting from December quarter 16, when demonetization happened, of course they were impacted. And the pipeline impact was much more severe than the off-take impact. So you have to keep this in perspective when you look at the growth numbers.
Okay. And just last question, sir. Any guidance on CAPEX? I know you don't give guidance, but any thoughts on CAPEX? You've done 1,000 crore and 850 crore in the last 2 years. And with the strong volume growth which you're looking at, is there a need to invest? And also, what proportion of your manufacturing is in-house versus outsourced?
First is we never shy away from investment, whether it is BMI or whether it is CAPEX. Yeah, if there is a need, if we keep growing at the robust volume growth numbers, and whenever there is a need to invest, we won't shy away from investing. But if you were to look at a long-term trend, we invest capital expenditure in the vicinity of 3 to 4% of turnover. Yeah, that's the normal long-term trend. But of course, it peaks whenever there is a substantive investment that we make.
I think I've also called out, rather than getting into what's in-house and third party, I think we're also re-looking at our total, as I called out earlier. We're looking at our total footprint, and there'll also be some CAPEX which could be related to that. But I think let's leave it and then monitor as we go.
Consequent to GST, consequent to our BIMI strategy, we are gone through a complete refresh of supply chain strategy.
Would that mean more insourcing or the reverse? Any insight there?
It depends. I don't think at this reason there is either. So ideally we could see some more insourcing as a broad thematic.
Yeah.
And but that's the best way to do it.
But we don't look at it from a lens of what percentage insourcing and what percentage outsourcing. We look at it from a perspective of segmenting the supply chain. We look at it from a perspective of total cost. And we look at it from a perspective of our ability to service the market effectively.
Understood. That's it from my side. Thank you, sir.
Thank you. The next question is from the line of Amit Sachdeva from HSBC. Please go ahead.
Hi. Thank you so much for taking my question, and congratulations on very good set of results. So I have a question which is a bit of a follow-up from the detergent thing we're talking about. And I just made one observation. It may not be pervasive across channels, but it seems that, while Percy was referring to that not response, but I actually found out in some channels you have like-to-like response to, say, Ariel, which was on 2 kg pack was 39% discount. You had the similar discount. And the fact that the growth has been very robust, and while this price competition is going, or at least in some channels, but it seems that price elasticity of that is very, very good, and 3x of the premium range of the 3x growth across 3x growth of the detergents in the premium segment, it's perhaps a testament to that. So can you sort of give it some sort of a landscape for the premium segment that you see, the opportunity that you see? So, for example, if you could give us what is the premium end now of the total sort of detergent base versus, say, 3 years ago, and how sort of the mass end is sort of shaping up in this whole game? Are you sort of gaining actually from the mass because since the promotion on the top end is high and it's actually improving the mix much faster? So what's the dynamic being played out there, if you could sort of clarify there?
I'll give you a very simple answer, that 1 in 10 wash is only premium wash. So there is a massive scope still to upgrade the consumers from mass and popular into premium. The second answer I'll give you is that our premium brand is now the largest brand in value terms. And the premium brand continues to do remarkably well. And as a company, we are, on a secular basis, our portfolio is moving up to the premium channel by about 100 bits per annum.
Sure. So that's a revenue mix change. Or is that
volume ka, I gave you the story of 1 in 10.
Sure.
I gave you the value also.
Got it. Well, that's very helpful. That's very, very helpful. So I think that's obviously answers part of my question. But secondly, if you could talk about, I think the natural space obviously seeing more intensity from the product launches point of view, while, the aloe vera gel in Lakme seems like a very interesting launch. And can you sort of indicate what sort of price index would it be to sort of similar products in the marketplace?
Again, the way we look at our portfolio is we cover the price-benefit pyramid. We never are players who play only in one part of the market. And whether it is, even if you look at Lakme, you have Absolute at the top end, and then you have L18 at the entry level for teenagers.
Sure.
Across the level, we straddle the pyramid, and wherever we see opportunities, we come in with propositions where they could satisfy the consumer need. So if you look at Lever Ayush, we are mainly at the belly of the market or a slight premium to the market.
Right.
Whereas if you look at Indulekha, that is at a significant premium to the market. So we play the game in a manner that we can cover the price points and the benefit.
Sure. So, Sanjeev, in this natural one, is it like a selective launch right now, the aloe vera thing? It is going to be only modern trade driven. How you're going about this? And are you sort of seeing it launch nationally across channels? How is it going to be sort of distributed?
What WIMI has allowed us to do is to play the game selectively. And if we choose to go nationally.
Sure.
Since Lever Ayush food products that we have launched, we have done it only in the state of Tamil Nadu. When we launched Domex powders, we launched it in Andhra Pradesh, and then we extended it. If we look at the Italian noodles, we launched it in Maharashtra, and then we have extended it. So we also do live test market, and then if it works, we roll it out.
Sure. But I was very enthused to see this because I think one of the Patanjali variant has done particularly well in aloe vera sort of skin gel, and which built a market of 700-800 crore very quickly. So I thought this was a very interesting and premium variant of maybe a mass product, and could also be taken up very quickly because this market is already there, and could be very, very interesting to launch if it's sort of spread across channels very quickly.
It is a fabulous product, and I would certainly urge you to take it as a gift for your partner.
Sure, Sanjeev. We'll try to do that. Perfect. Thank you so much and all the very best. It's a great set of results. Thank you.
Thank you. The next question is from the line of Abhijit Kundu from Antique Stock Broking. Please go ahead.
Hi, sir. Congrats on the good set of results. My question was a follow-up, essentially, on the strong growth in EBIT shown in home care. Would it be right to say that, a significant part of that, essentially cost, what you said was there was mix improvement, cost savings, and which has gone into it. So, looking at your ad spends, which have gone up by about 27%, would it be right to say that a major part of that was in personal products and personal care and not in home care? And home care margins have been to an extent held, aided by lower raw material costs or mix improvement. I mean, how much of home care improvement? I don't want a specific answer, but would cost savings be a big part of that in the margin improvement in home care?
So Abhijit, let me try. I think I tried explaining it a bit earlier in the call. As inflation has started to come through in home care, we have started to look at judicious pricing as well. Yeah.
Right.
So there is a bit of a pricing which comes slightly ahead of while the replacement costs have started to go up. Yeah, because you'll be carrying some inventory covers and some of the hedges. So your actual impact into the P&L in the quarter could have been a bit muted, but we started to look at some of judicious pricing which has commenced. We've also talked about, and Sanjeev has talked about, some of the premiumization which is happening across and more so in laundry. You've also seen the benefits of a positive mix which comes through play. And there is also the savings agenda, which depending on the projects and when they land, there will always be benefits which will not be equally phased, and it will not be same across all categories. So to that extent, yes, we have had a bit a higher benefit which has come through in home care for the quarter. And that's why I said as you look at a slightly longer picture, because now you will start to see the effect of some of the costs coming through. And therefore, I think this will be best. A realistic position would be to see it over a few quarters rather than read too much into the increase within the quarter. The other part, which was question, was really on BMI. And by nature, yes, the increase in BMI spends will be higher in personal care in relation to the others. But that is the nature of the business, and we continue to invest behind many initiatives. And therefore, there has been a step up in some of our personal care categories in BMI.
Yeah, there is also one more clarification, I think, for the benefit of all the people on the call I would like to give is, we play the total portfolio for the company. Yeah, we look at underlying gross margins of our brands and categories as a health indicator. Then we deploy the funds where we think it is most appropriate and needed. And many times, we invest the funds not just for an immediate gain, but we invest the funds for a long-term gain. Things like market development or when you launch a new brand are not things where you will get immediate results. You'll get a long-term result. Right. So we play the portfolio, and so I wouldn't say that just look at 1 or 2 quarters, and I would certainly urge you not to jump into conclusions. The underlying health, we look at it from a gross margin lens and then deploy the funds based on innovation, activation, market development, and competitive activities in the marketplace.
Right. Got it, sir. Thanks. That's all from my side.
Thank you. The next question is from the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, so just had a few questions. Firstly, on the pricing side, this 400 bips pricing growth that you've seen in this quarter, would this be largely led by the pricing actions in the current quarter, or would there be a certain element of pricing which has happened in the base quarters? Because if I understand, most of the earlier pricing would have now anniversarized.
So if you see the previous quarters, if you see what used to see a bit of higher price growth, if you saw in December quarter and you would have seen in March quarter on a comparable basis, you would have seen it higher. In this quarter, you've seen it lower. There are multiple factors at play. There's a bit of anniversarizing, there's a bit of carryover, there's a little bit of fresh pricing. There's a combination of all of that. It will not be right to call that most of the pricing is an in-quarter pricing. You'll also have to take into account some...
and also one more clarification, if I might give. You know, when we look at price growth, it is not just linked to MRPs. Remember that.
Yeah.
It is also linked to the changes in consumer promotion and trade activities.
Right. Fair. The second thing was, on getting the food and refreshment division together, does this also result in certain, level of cost saving, at any level, or is just a reporting, kind of a thing?
I think first and foremost, this is not for an efficiency in terms of some headcount and people. Yeah, because if you look at by nature of this, the opportunities which are there, sizable opportunities both in refreshments and foods. I think what it does for us is that it puts back some natural synergies that we can drive. It also is in sync with, let's say, how some of the global Unilever organization is structured. And therefore, I think maintaining the sync also ensures that we are able to better tap into innovations and the growth opportunities. So it is more a rewiring of the organization to enable growth. It's not an efficiency game.
Got it. The third thing was on the restructuring cost side. So would there be, apart from the 59 crore, exceptional, would there be certain elements of that cost sitting in some of the expenses also, either employee or other expenses, or it would be completely, put in the exceptional item?
So it depends on what is a restructuring. I think there's a very clear accounting definition to it. If you are able to pull together a business case with long-term benefits and costs associated with it, and if it passes the muster, then they come into the nature of restructuring projects. If it is any tweaks that we do in the normal course of operations, then that will come into normal operating expenses. In this case, it's a clear supply chain reorganization on certain large components, not large, some key components of our supply chain, part relating to industrial footprint, part relating to distribution, and therefore with a very clear benefits investment payout, and therefore it's at in restructuring.
Got it. My last question was on the competitive intensity that you called out. Would this be, is this a more broad-based thing, or you're seeing it in more in pockets? I may have missed your comment on that.
Yeah, so we talked about it. It's getting played out differently in different categories. I think you'll see the full detailed answer I gave. Maybe if you see in the transcripts when they come to. But suffices to say that look, it is happening in different categories with different competitive set, and therefore it's not any one or two players across broad base, but it's coming through in different categories, different competition set. Yeah, you would have also heard some of the specific questions of the nature that you heard from some of your other colleagues on the line. That also starts to give you a flavor. It could be promotion somewhere, it could be advertising somewhere else, and so on and so forth.
Got it. That's it for me. Thank you.
Thank you. The next question is from the line of Trilok Agarwal from Birla Sun Life. Please go ahead. Trilok, your line is unmuted. Please go ahead with the question. Seems there's no response from the line. We'll move to the next question. That is from the line of Prasad Deshmukh from Bank of America. Please go ahead.
Hey, good evening, and congrats on a great set of numbers. A couple of questions mainly on your naturals portfolio. Lately you basically went pan-India with Indulekha brand. Just wanted to know how is this brand performing across your different VME markets, especially in markets like, say, which are predominantly rural. What is your growth strategy in these markets?
Yeah, it continues to do as per our plan as far as South India is concerned. As far as Central India and North India is concerned, we are tweaking the mix. And our plan... Indulekha. Okay, I'm sorry. Indulekha continues to do very well wherever we have extended.
So despite the premium pricing, it's doing well even in Central India and North India?
Absolutely.
Okay.
And also it has continued the shampoo. It is initial days, but we are very happy with the reception in the marketplace. And just to complete my conversation on Liver Ayush, so we are tweaking the mix. And what we have seen is, like it happens for many categories, the early adopters are in the modern trade and in the top end of the general trade.
Okay. Just to clarify, I think what Sanjeev was saying probably got disrupted. South, it's doing well and coming through. In North and Middle, in the central parts is where he talked about certain tweaks to the mix. Just wanted to make it clear.
Sure, got it. Second question on Citra. Is there any update there, especially with Indulekha and Ayush doing well? Do you still see a necessity of third brand focused on, say, natural kind of platform?
We are re-looking at the whole portfolio of Citra, and we would be refreshing the mix. And it did not deliver on our action standards in the first launch. So we are looking at it, how do we make business out of Citra?
Okay, got it. And last question, sir. In terms of these investments that you are making in reorganizing manufacturing and distribution footprint, by what time frame can one start seeing impact of this flowing through P&L?
So it depends, Prasad. It's difficult to answer that in black and white, but typically you would say that if you do some of these charts for now, you start to see the benefit in +2 or +3 quarters. Because typically what happens is you need to start announcing when you have a restructuring plan and you make an announcement, you have to take a cost charge. After that, you still have to go through the implementation of restructuring the operations, the assets, the manpowers. So anyway, it takes, in some of this depends on what it is, at least 3 months is a bare minimum, but it's more likely to be in the 6 to 9 months of time horizon, and then you start to see the benefits into the operating line.
Okay, perfect. Thanks a lot. Those are the questions.
Thank you. The next question is from the line of Anubhav Sahu from MC Research. Please go ahead.
Hello, sir. Hi. I have this specific question, oral care. Basically, it's the third quarter when we have seen some growth traction in the oral care space. So wanted your view on that. If you can elaborate what has gone in our favor in last 2 quarters. Is it our own strategy, some regional variation in that, whether we have gone better in South compared to North, as has been highlighted one of your peers in this category? Or is it the competition itself has gone weak?
Sir, I think, again, Sanjeev talked about it a little earlier in the conversation. So we've seen another quarter of growth. Now, this is a business which has been challenged for many quarters, and now we are at least started to see some growth come back. We also clarified that, look, Close-Up has been doing a bit better than Pepsodent. There is more work to be done from a Pepsodent point of view. We've also gone in with new communication. There has been some change to pricing and pack architecture in certain geographies, so that's helped us. There is also Ayush, which is also helping us in select geographies from an oral care point of view. So I think these are some of the enablers which have now started to give us some growth, but clearly there is more work to be done before we can really say that, look, we've got oral back where it really belongs.
Okay, sir. So, is there any pecking order in the geography in terms of success we had in the comeback of oral care?
No, I don't think there is any specific reason to start calling out geographies. And, yeah.
Okay, that's fine. Thank you, sir. That's all from me.
Thank you, Anand.
Thank you. Ladies and gentlemen, at this moment, there are no further questions from the participants on the audio line. I will now hand the call proceedings to Ms. Suman Hegde for web questions. Thank you, and over to you, ma'am.
Thanks, Aman. We've got a few questions on the web option. I will not repeat the ones that we have already taken. The first question comes from Manish Oswal from Nirmal Bank. There are a few questions that he's posted. The first one being, which is the business segment where the management feels the WIMI strategy outcome is below our expectation?
First is WIMI is our competitive weapon. WIMI is now a way of life. It gives us immense agility. It gives us flexibility. And it allows us to play to the real India, which is not a homogeneous entity, but a very heterogeneous country.
The second question from Manish is the company reviewing payout or other alternatives like buyback to the shareholders? Srini, what is it?
So, Manish, we continue to look at the optimal use of cash. Yeah. So if you really look at our dividend payout, there is a consistent approach we take to payout. And I think that is something which is ongoing. Historically, we've also looked at options to say that, look, if you're able to get that money which is locked into share premium and others which comes into reserves, that will even again give us the flexibility if we were to think about returning cash to shareholders. Clearly, we will, if I look at pecking order, we continue to like to invest into the business. We continue to look at inorganic opportunities if we are able to land them. And thereafter, we will really look at the best and the optimal way of returning cash to the shareholders. It could be dividend, it could be buyback, or it could be any others. And that's something we continue to actively look at and in consultation with the board of this company.
The last question from Manish is on, can we sustain the double-digit volume growth in the remaining part of FY19? What are the key risks to the current margins and operating margin outlook, budget ad spends, which we'll be looking at vis-a-vis FY18 versus FY19?
So that's a nice rounded way of seeking a guidance from us, and I'm afraid we don't give guidance.
Okay, the next question is from Nitin Gosar from Invesco. Does UVG include promotional volumes too? Yes, it does include promotional volumes. It's the total volume sold by the company in the quarter across categories. The next question coming in from Amit Kumar from Investec. Which brands are driving this 2.5x growth in naturals? Is the company versus the company's average, given that home care, which is the fastest growing category, has limited natural propositions, and Ayush still has work to be done apart from the South market, which has been highlighted?
We have very clearly articulated that we have three legs. One is the variants in our existing portfolio, and there are a lot of brands which have now got natural variant. Even the Pudina variant that we took out in Vim Bar is doing exceedingly well. Then we have the master brand, and then we have the specialist brand like Indulekha. So on a total basis, our growth is growing at 2.5x. But you have to understand that we are building from a small base.
There's one more question from Amit. He just wants a clarification on slide 8 on the presentation. Which of the adjustments noted taking reported sales growth from 3% to 16% comparable sales growth would yet be valid in quarter 2 of FY19? Or would quarter 2 reported and comparable sales growth converge?
So broadly they will converge, because if you see, and most of it will converge, because if you really look at it, there is excise which then anniversarizes. There is input taxes and some of the things that will also anniversarize. There will be a very small effect of government grants, because if you really recollect, in December quarter of last year, we had to take the correction. So there will be a very small component of which will be left, but most part will be out of this comparable versus reported, and we should be able to start interpreting numbers as they get reported.
Thanks. The next question coming in from Gopal Krishnan from ICICI Lombard. There are quite a few initiatives enabled by social media to create personal products. How do you see the disruptive strategies impacting this segment?
If you want to be a niche player, then you can rely just on one medium. If you want to be a scale player, then you have to use different medium that is available for you. For us, we play across the spectrum. Yeah, there are brands like Brill Cream, Male Grooming, which we have recently launched, that's just on e-commerce. And there are many brands like, for instance, Pure Derm, which we launched recently, that is across the mainline spectrum.
Thanks, Sanjeev. The last question on the web that we have is from Siddhant Chabria from HDFC Securities. What is the like-to-like growth in other expenses? It grew only by 2% versus a 16% revenue growth. What is the sustainable growth for other expenses?
So again, Siddhant, we don't give guidance on some of these lines, but I think it's important to clarify a couple of elements. Parts of these other expenses has got to do with linked to our volumes and volume growth. So to that extent, they will really be variable costs as we continue to do more volumes with our third-party suppliers. You will see a direct decrease. Part of these costs will be fixed in nature, and to that extent, we will continue to get the leverage benefits as we see growth. So there is a few components sitting there, and therefore part fixed, part variable. But in aggregate, we are not going to give any guidance in terms of what you're likely to see in terms of an increase or a decrease there.
Okay. Thank you, Shani. Thank you, Sanjeev. That's all we have on the web queue for today. With that, we have now come to the end of the Q&A session. Before we end, let me again remind you that the replay of the event and the transcript will be available on the Investor Relations website in a short while, and you can go back and refer to it. A copy of the results and presentation, if not with you, is already on the website, and you can go back and refer to that as well. With that, we would like to draw this call to a close. So thank you, everyone, for your participation, and have a great evening.